Hey everyone, welcome back to Corporate Decoder, the place where we take the most boring documents and make them, well, slightly less boring and a lot more profitable for you to understand. Today we are diving into Cannabis Suisse Corp's latest annual report, and let me tell you, this one is a real, well, it's a real journey. So Cannabis Suisse Corp filed its annual report and it's a doozy. What's really interesting here is that despite the name, this company has absolutely nothing to do with cannabis anymore. It's all about renting out commercial spaces now. The big takeaway is their financial situation, which is, let's just say, it's a challenge. Right off the bat, the auditors are flagging a going concern issue. This is like a doctor saying, I hope you feel better soon, but there's a real chance you might not make it through the week. Essentially, the company's financial statements haven't been prepared with the assumption that they'll be around for much longer. They've got recurring losses and a big hole in their finances. Looking at their balance sheet as of May 31st, 2025, it paints a pretty stark picture. They have total current liabilities of over $325,000. That's the short-term debt and bills they owe. But compare that to their total current assets, which are just over $106,000. That means they have a serious shortage of ready cash to cover their immediate obligations. It's like having more bills to pay than money in your wallet. And then there's the accumulated deficit. By May 31st, 2025, it had ballooned to over $3 million. This number represents all the losses the company has piled up since its inception. It's a giant red flag showing they've been spending way more than they've been earning for a long time. Let's zoom into their actual performance for the year ending May 31st, 2025. They brought in $22,000 in rental income. Sounds okay, right? But then they had costs associated with that rental of about $22,000 too. That leaves a measly 430 setley swimming in cash. And when you factor in all their operating expenses like professional fees and general administrative costs, the picture gets much worse. They posted an operating loss of almost $288,000 for the year. That means even before accounting for interest or other weird expenses, just running the business lost them a ton of money. The bottom line is even uglier. For the year ending May 31st, 2025, their net loss was over $456,000. This is a huge percentage of their revenue, showing how much they're struggling. It's a 1 in 20 situation where their losses are massive compared to the money they actually make. And despite all this, where's the cash? As of May 31st, 2025, they only had $2,850 left in their escrow account. Compare that to the over $96,000 in current assets they have. It's a tiny amount of cash to manage all those liabilities. A big part of their financial entanglement comes from related party transactions, especially with their CEO. They have significant amounts owed on convertible notes payable to related parties. For example, one note alone is over $2 million. These are loans that can be turned into stock, and there are several of them with varying terms. The company also seems to be using stock and debt to settle its obligations. For instance, there's a note for over $86,000 issued to their CEO for unpaid rent and advances. This shows they're juggling debt and trying to manage it with new financial instruments, which can be a risky game. The company is also dealing with operating leases, which are recorded as right-of-use assets. They have over $500,000 in these assets on their books. These represent the company's right to use properties they've leased. However, with such a low cash balance and high liabilities, the ability to maintain these leases long-term looks shaky without new funding. Beyond the money issues, the report highlights some serious internal control problems, which they call material weaknesses. Firstly, they admit to not having an adequate control environment or proper corporate governance. This means things like formal approval for related party deals are missing, and the board isn't really independent from the CEO, who wears multiple hats. They also state they don't maintain appropriate internal controls. This is a big deal. It means they lack formal accounting procedures, have limited supervision, and don't have enough staff with the right accounting knowledge. This lack of robust internal controls increases the risk of errors and fraud going undetected. It's like building a house with no solid foundation. And because of these major issues, management has concluded that the company did not maintain effective internal control over financial reporting. This is a critical finding because it means the numbers you're seeing might not be as reliable as they should be for a publicly traded company. It's also worth noting that Scott McAllister is listed as the CEO, CFO, and Principal Accounting Officer. Having one person in these key financial roles, especially when there are material weaknesses in controls, is a significant concentration of power and responsibility, and it raises concerns about oversight. Looking at who actually controls the company, Scott McAllister, through various means including potential stock conversions, holds over 51% of the voting stock. This gives him ultimate control over all company decisions, from strategy to finances, and with the current financial situation and control weaknesses, it's a situation to watch very closely. So what's my take as a corporate decoder? Cannabis Suisse Corp is in a very tough spot. Their revenue is minimal, their losses are substantial, and they have a massive accumulated deficit. The going concern opinion is a serious warning sign. Add to that the weak internal controls and the single person leadership in critical financial roles. And you've got a recipe for significant risk. The company seems to be operating on a shoestring budget, heavily reliant on its CEO for funding and dealing with overdue obligations through complex debt and equity maneuvers. The overall health of the company is currently very poor. They have a massive deficit in stockholders' equity, meaning the liabilities far outweigh the assets. It's like owning a business where you owe more to creditors than the business is actually worth. The story here is one of a company struggling to find its footing, burdened by debt and operational losses, with serious questions about its long-term survival. While they are in the real estate rental business, their current financial performance and infrastructure control issues cast a long shadow over their future prospects. Alright, that's our deep dive into the Cannabis Suisse Corp filing. What do you think about their financial situation and control problems? Let me know your thoughts in the comments below. If you found this breakdown helpful, please smash that like button, subscribe for more corporate exposures, and join our Discord community in the description for more in-depth discussions. Thanks for watching.